earlier in the morning around 8 and went to bed maybe. If you look at the order block here, bullish candle prior to the move going lower, short-term high, that would be just below, okay, short-term high below the intended order block, that would be bearish. Okay, you see that? And market structure price swing from the high to the low right there. So we have optimal trade entry in here, order block here, stop being taken out here, may or may not have been filled there. Fancy dancing around, may not have, maybe not have had an opportunity using that specific entry point. We have a bullish order block here that does reside with the sweet spot in here, which is, I think, is nice. But if you're reaching for that 79% retracement level, which is what you hear me not try to drive too hard, I like to use the sweet spot if I can, but risk permitting, the 62% retracement optimal trade entry level is where I ideally do most of my trades. So again, you can go back through all my other material and you'll hear me say that. It's wonderful, and when I show examples of how the 79% retracement level really encapsulates the high and low of the moves, everyone assumes I'm getting that price. I'm not getting that price. Many times I'm getting this price here, or something in between the 62 and the 70.5 level. I might try to get creative and look for a level in there, especially if it's a round number. In this case, we have 170.90, which would have been a really good opportunity on this particular day. But my point is this: you see how they're running liquidity into the market by blowing out buy stops, okay, causing the market participants that had stops here to be buying at the market. Well, who's going to take the other side of that market trade? The smart money. They're selling it to them, and they're going to hold that position profitably. All right, let's go back out to a 15-minute time frame. It's getting a little messy looking at this. Okay, we have a short-term high in here, range, order block right there, fell just short of it in here, so no trade early in Frankfurt. And then we have bullish order block right here, intraday, right there. We are now inside of the New York kill zone. Short-term high, range, high to low. This is the market structure price swing that you'd have to use. Parent price swing. Price trades up into optimal trade entry. Right in here is your potential entry for the 1300 GMT time and subsequent price drop. Okay, we have price. I think I'm just going to use a little rectangle. Right in here, stops will be resting above this high. Parent price swing, market structure high, down to the low. See that price swing here? Equilibrium right in here, halfway through. So you have a price swing high, down to low, then a measured move from high to low. And let me give you an example of what I'm talking about there. So you can see the symmetry that's in the market. So you have this range from this high down to that low. If you look at the range here, it's almost the same thing. So we have very good market symmetry there. Very good symmetry. Okay, see that? Extend that out. Only had one inherent wick prior to move higher. I only toss that in there because I love seeing it when it happens. It's really really outstanding when you have something like that. It lines up with your understanding of where the market should be going. We have a market structure high here, bullish order block, and the parent price swing is down here, so we would pour a fib on those two price points. Okay, this low to this high. Optimal trade entry is just a little short of the order block. Stops are indeed ran out. Using this price high right in here with this low as your minimum threshold for order block here. There's your bullish order block here. Same scenario with stops above here. Runs into it during London Open. Let's move over so you can see a little bit better. Yeah, see. Optimal trade entry, again, falling short here. Okay, so we don't have it so much in confluence of optimal trade entry and order block itself, but all the other components are there, which is kind of like gets back to the notion that you're going to be in a gray area. You may not get all of the things lined up, but you still would have a lot of other factors that would, collectively give you a confluence for the trade. Remember, during this time frame in July, we had already worked the idea out that there's an USDX SMT divergence. In other words, the dollar was unable to make a lower low, and the cable had made a higher high. So we are seeing distribution and accumulation in the dollar, but distribution in the cable. So we are in a sell program. So any rallies after the 12 midnight or 5 GMT time frame, it would be viewed as a Judas swing. Okay, so the optimal trade entry, while it was short of it here, okay, it's short of it here, it doesn't change the fact that you would still be in a profitable position because we're always using a minimum of 30 pip stop loss, going into the market, especially trading London. And just to give you a further view, even if we were using the parent price swing, which is this high to this low, and say you were doing your trade in here based on that assumption, returning back to this order block here, if you were getting short at the 62% retracement level in here, that would be right in here. That would be 170.78. Round that to the nearest round number. You got 170.80. Okay, you're inside the optimal trade entry, and you're also back inside this order block here, bullish candle, and it does run out this short-term high prior to it. So it does give you an ideal entry point there inside of London too, because this candle on the high comes in at 8:15 GMT, which is the heart of the London Open kill zone. Okay, and this one here, I'm tempted to go over the mitigation block because there's a lot of examples of it in this section of market data that we're using to teach the principles that were used all throughout this year in 2014. Just know that this low back here will be talked about, and we'll just have to revisit it at that time. But for now, we're just going to say for a moment you didn't know anything about mitigation blocks. Okay, we're going to just assume that for now. And we can see clearly they have a low here, and the market had a nice little turning point in here. Okay, and we also have the bullish candle prior to the move lower, and we also have the body of the candle, this bullish candle as well. So this is a good level. Stops, if I can get this rectangle to work with me, would be just above this short-term high, and let's assume again the same thing. We have a high here, move prior to the drop, prior to the rally up, which is right there, this low. So it's this high to this low. This is the range you pull your fib on. This is where you would be entering, okay, right in here. So inside of this area right in here, this is London Open. This would be a good fill. You're also coming back and blowing out the stops here. Now, if your concern is, well, wouldn't I be stopped out there? No. And this is really what I want to kind of get at too. Once you have an understanding, there's 30 pips. Right there's 30 pips. And say you're getting in right at the 62% tracing level, right there. Okay, your stop's up here, way up in here. Okay, and is not ran. So you can see clearly that it did offer some good reward to risk parameters for this particular day. Again, the idea is if you're looking for really, really, really good trade setups, because I'm not trying to teach you to trade every day. I don't trade every day, okay? But if you're looking for really one good setup a week that really lines up, a good level of confluence of events and factors, this is one way that you could arrive at that goal. Now, you don't need to have all of them lined up to get a trade, but the more you have, obviously, the more cherry the setup. Okay, but ideally what I want you to learn is that if you are anticipating a selling scenario, okay, you want to see a rally after the 5 GMT, or what we commonly call New York's midnight time frame, the short-term high prior to it, a rally above that, because they're going to take stops out, and once you see that, you'll see the market turn on the dime and go the other way. Short-term high here, the market rallies after 5 GMT, takes a dump. Okay, we start going into a consolidation in here. We're going to assume, say you lost money on this day right in here on the 28th. Well, the same scenario unfolds the very next day. You have a short-term high, we rally up into an existing order block. Okay, sell it, boom, power 3. Okay, in here, same thing, just got to look a little bit closer now. Okay, yes, they have a high up here. The move after 5 GMT, okay, trades lower, trades lower, trades lower, trades lower. But then we got to go back and look at what's been going on prior to this move. And we'll talk more about this in volume 5. But right in here, there's something that's very, very influential in terms of price. Okay, and you can see a short-term high here. It gets ran out above this high here into a previous order block right in here. Let me draw that in there because I know some of you are thinking, it ain't there. See that? Boom. High of that candle is 169.40. The low of this candle, 169.40. Okay, so precision, precision, precision. Okay, but again, I know I'm probably driving you nuts by not talking about this, but it's in the next video, guys. Just relax. In fact, we're going to use these same examples, though, if that helps. We have a similar scenario here. We have a short-term high in here with the understanding that we expect lower prices. 5 GMT or midnight, we look for a rally up, take out those stops, returns to a previous order block. Okay, sell it, boom. Okay, same scenario here. We have a short-term high in here. Okay, early stops in Frankfurt. They gun it up higher, taking out the stops. returning to previous order block. Boom. Sell it. High probability. Consolidation. Say you lost money. No problem. People lose money sometimes. Same scenario here. Okay. Maybe maybe you didn't have a trade here. Maybe you did or didn't. I don't know. Okay, but let's just say you didn't. I know I didn't trade here because this was the week going into my birthday, and I didn't do anything there. No trade there. Nothing would have been triggered on that. Okay, here's a nice one. We have bullish candle prior to move lower, midnight time frame, short-term high. Okay, notice it only needs a lower high on either side of it. Okay, and once it creates that, stops will build on that because it'll look like this to everyone at the time. That's a bear flag. Everyone's going to say, oh, it's classic bear flag. Look, it's found some resistance here. Okay, in fact, I'll draw a line, go back to this high here. Okay, and say, well, look, this is clearly resistance. It's in a bear flag formation. It's been dropping, so we're gonna sell it here and put a stop loss right above this price point here. You should be looking at this as a price high, okay, in this order block. And when it gets back up to minimum threshold of 168.54 after midnight, after it guns out these highs, this high short-term stops right in here, boom, you're looking to be a seller. Okay, and then the result is profitability. And then that same expected bear flag formation here did eventually materialize, but just wasn't able to pay those participants that were trying to take advantage of it then. Same scenario here, bullish order block prior to move lower. We have a short-term high in place inside of the price swing or range. You have an impulse move higher. Then have a minor retracement inside of it. Stops will build above this high. They gun it, boom, after midnight. Okay, into the order block, sell it, bang, right there. Lower prices as a result. Okay, you see the repeating theme? By having the higher time frame premise in mind, you'll know what they're going to do and where they're going to inject volatility and liquidity. The liquidity that rests above short-term highs in bearish markets is where they're going to gather up and collect and accumulate new shorts and knock out those participants that would have been profitable. Think about it. If those individuals that were short in here were never knocked out, they'd be profitable down here. You think the banks want that? No. You think the large institutions want that? No. You think your brokers want that? No. Okay, so all of those things are going against you as a trader, so you need to be thinking about that when you're taking your trades. Here's a day that you may have lost money again, and here's another day they say you would have lost money as well. Very next day we have price moving. Here's a short-term high. Here's midnight time frame. Now understand what we're looking at. Okay, we have a low here, and look at the high back here. This is why you want to look at your charts away, like turn your computer on, look at it, sit on the sofa, and have it sit on, maybe a coffee table across the room, and just look at it from a greater distance. Because again, if we start zooming in and only looking at the little minor moves like this, you're going to forget about these parent price swings like this high down to this low. And these are some of the things you need to be doing as you cycle through your time frames. Obviously, everyone has their pet time frames. You mind daily, 4 hour, 1 hour. But this is the price swing that you need to be aware of. This low to that high back here. If you don't have that in mind, you won't ever see these events. Okay, where after midnight, price runs a short-term high where the stops are. Boom. Even in Frankfurt, we have double tops. Everyone calls this stuff in retail world, and it's just like a magnet for everyone to put their stop loss right above it. And you see that happening right in here. Boom. On this candle at 9:30 GMT, August 13th, 2014. Boom. Right there. Okay. That particular day, okay, would have been astronomical in terms of profitability. the parent price swing, you have an order block here. You have a very handsome order block right there, which actually lays right on top of the 79 concentration level, which is really good confluence. And with that in mind, that particular level, it looks like it's around 168.42. Is that what that is? Yeah, 168.42. Round it to a round number, 68.40. That should be a good entry, and it's still very close in proximity to the low of that particular bullish candle, which is a bearish order block. So again, we could go on and on and on and on and give examples of where it did work and where it didn't, and still be, if you took the positions on a weekly basis, you certainly can find and ferret out some really good and outstanding bullish and bearish order blocks. Now, I gave you examples of the bearish side. Everything is the same thing, just on the reverse. You're looking for a swing higher, and when there's a low, you want to see the lows blow out a short-term low, where stops would be, and then it would continue higher. So everything you're seeing here on the sell side, just reverse it for the buy side, and that's going to take a little bit of homework on your part, and that's good. It's not all about me giving you cherry-picked hindsight perfect examples. I want you to look at the charts and see for yourselves across a numerous of pairs of currency pairs. In other words, looking at not just the cable, look at the fiber, look at the Aussie dollar, look at Kiwi, Canadian. Um, it's important that you understand it, and even the dreaded yen. I don't like it, but it works there too. I just don't like that pair. The all these concepts are there for you to be studying and building an ideal framework for how it works in the past and anticipate seeing it in the future. And again, that's where the learning takes place, seeing it unfold real time in your own charts, marking them up in advance, saying, okay, there's a high here, we're in a sell program, they're going to take the stops most likely and return to a previous order block, and at midnight we're going to see that Judas swing move higher, sucking everybody in on the wrong side of the marketplace, and then there you go. You see it taking place right there. And since it's a wonderful example here, I'm going to close this video on this point and encourage you to do your own study. Don't take my word for it. Look at the charts, study it, and when you start seeing these factors build upon one another and you get a greater confluence of things, you'll be able to build a greater trust in the order blocks that you're trading off of. And understand that the 30 pip stop loss is your shield, even though you may have the overall context correct. If you try to trade with too short of a stop, it can still be right in your directional premise, but be taken out nonetheless, and not see the profitability that would be available had you used the 30 pip stop. So until then, guys, until we move over to the fifth installment, I wish you good luck and good trading.